All right, this video is eventually going to walk through example 7.4.1 where we find the required return for a stock using the capital asset pricing model, or CAPM. But first, we'll read through it, and there's a lot of new terms here that I want to back up and unpack so we can talk about the concepts. Because once again, we've got a pretty straightforward calculation. We just have to follow order of operations as we do it. But there's a rich concept or group of concepts behind what the capital asset pricing model is and what we're even talking about with the required return for a stock. So let's read this one real quick. Suppose you are considering buying a stock with a beta of 1.7. What is your required return given by the CAPM if the expected return on the market is 9% and the risk-free rate is 2%? All right, then the solution just says we can use equation 7.5 to find the required return for the stock. We just plug in the data and get this number. Okay, let's back up a minute because we've got two new terms here that we haven't encountered yet. We have beta, like it's a number, wonderful. What is that? We'll talk about it. And then we have required return, and that has a really specific definition, and it's important that we know what we're actually measuring with the CAPM so that we can apply it correctly. It gets, well, we'll get into it. It gets a little weird. Although it's simple to use, we just have to be careful it's simple to calculate, we just have to be careful how we use it. Okay, let's back up and talk about beta. This is actually a measure of risk, but it's a specific kind of risk. And to unpack what it is, I'm going to back up and look at table 7.2. Here we have, we looked at table 7.1 in the previous video. This one we've got, that had returns for Initech and Edison Power. This table has returns again for Initech and Edison Power, and it's the same time period and the same returns that we were looking at before. But it adds a third company, Fixitech. Now what Fixitech does is they specialize in repairing mobile devices, and they specialize in Initech's devices. So what tends to happen, the reason I picked this company is because what tends to happen is when the economy is doing really well and people break their devices, they'll just go buy a new one. They'll upgrade to do it. But if they're uncertain about their employment situation, they don't know if they're going to get laid off, or they don't know if they're going to be able to get raises, or they're just uncertain about future income, then they may instead choose to repair the device that they have. So what happens is the returns for these two stocks, or the expected earnings for these two stocks, tend to move in opposite directions. The economy is doing really great. People are upgrading and buying new Initech devices, and so Initech earns higher returns than they would have expected otherwise. And Fixitech has less business because people aren't repairing their devices. They're just, trading them in or doing whatever with them other than fixing them and keeping them. But when the economy is bad and people are uncertain, instead of buying a new device, if you crack your screen or whatever, they will instead take it and get it repaired and spend a little bit less money in buying a new device. So when the economy isn't doing as well, Initech tends to do less well and Fixitech tends to do better. Right? Because the more people are coming in, so they have more revenue coming in and they have higher earnings once they take care of their cost. So what we can see with these two companies is in 2016 and 2017, when we're in a boom and GDP is growing and people are feeling really optimistic, they're buying new devices from Initech. Their returns are up with the boost in expected earnings, and Fixitech is down because they're expected to do less business over this period. We enter the normal period and they're roughly the same, kind of half and half. Folks are buying new devices or getting them fixed. And so the expectations are about the same for these two companies. We enter the recession and they flip again. It's bad for Initech because they're going to sell fewer devices and have less earnings at the end of the day. But Fixitech is going to have a lot more business coming in the door and have higher earnings. And so their stock price will get bid up because owners of the stock are expecting higher future incomes and people want to buy the stock and they'll bid the price up while they do that. Okay, this motion turns out to be pretty important and actually clues us in that there are at least two different categories of risk that we need to be aware of when we're talking about financial assets. The last two columns on this table form two different portfolios, and a portfolio is just a combination of assets. Portfolio 1 is 50% Initech and 50% Edison Power. And what that means is, say for example, we have $1,000 we're going to invest. We'll invest $500 in Initech and $500 in Edison Power. The return on our portfolio, if we do that, is just a weighted average of the returns for the individual assets. So to get this minus 5.9%, what we do is take 0.5 times 15.1% plus, so 0.5 for 50%, so half of our value is in Initech, so 0.5 times Initech's return, and then 0.5, add to that 0.5 plus Edison Power's return. And we just add those two together, we'll get a minus 5.9% for the portfolio. So there's no change there. It's just a weighted average to calculate the return on the portfolio of two different stocks. So this portfolio one does that for each of those stocks, and what we see, if we look at it, we can see that the returns for the portfolio over this period, and then we've calculated the same statistics for the portfolio that we did for the individual assets. If we look at the average return for this portfolio that's half Initech and half Edison Power, over the 6-year period, it's about 13.11%. Remember, the average return measures what tended to happen over the sample period. And we compare that to the average returns for the individual stocks, 2.5% for Edison Power, 23.65% for Initech. This 13.11% is right in the middle. It's in between them, which makes sense. We've got half of our money in Initech and half in Edison Power, so this is really just going to be an average of the two in this case. Our risk looks kind of similar. If we look at the standard deviation of Edison Power, 1.9%, standard deviation of Initech at 37.23%, our risk of the portfolio is about halfway in between those, right? That's about 2% for Edison Power. It's almost 40% for Initech. And our risk on the portfolio, the standard deviation of the portfolio, is almost 20%. So kind of right in the middle between those two. And then the realized return, same deal, kind of in the middle. We'll worry less about this right now. More want to talk about what's going to happen with the returns and the risk when we look at a second portfolio. This is where things get really cool. In portfolio 2, we're going to take 50% Initech again, so half of our money is going to be Initech, and then half of our money is going to be in Fixitech. Okay? And we do the same calculations. We calculate the return on the portfolio, which is just a weighted average of the individual asset returns. In this case, say, for example, in 2021, we would take 0.5, so 50% weight, 0.5 times the 15.1% return in Initech, plus 0.5 times the 88.1% return in Fixitech, add those two together, and we'll get a portfolio return, which is an average of those two, of 36.5%. We do that for each year, and then we take the average of those returns, and we see the average return in our portfolio is 23.65%, which is exactly what it was for the two assets, because both of these have the same average return and roughly the same risk if we're looking at them. Right? So the average return for both of them is 23.65%, and the risk is roughly the same, a little over 37% for both of the individual assets. But look what happens when we calculate the standard deviation of the portfolio's returns. It's 11.93%, almost a third. Right? Maybe a little less than a third. I don't know. I haven't done the calculation in a while, so I forget. But it looks a little like maybe a little less than a third of the risk of the individual assets. What is going on here? What happened to the risk? Well, because these two stocks tend to move in opposite directions, they kind of act as insurance for each other. When one is down and you would be losing money, the other one is up and is compensating for the other one being down, and then they'll flip every once in a while. So what happens is we get this risk reduction because they kind of cancel each other out. Now the returns don't cancel each other out, right? They're roughly the same, but we eliminate some risk associated with the portfolio. So we tighten up that distribution, and we're a little more certain that this average return is what we can expect to see next period, right? Because remember that standard deviation tells us how far on average each observation tends to be away from the mean. Well, it's a lot smaller here, right? And so our confidence interval gets a lot tighter. If we want to say we expect our return to be 23.65%, we're 68% confident that that's going to be within plus or minus 1 standard deviation of that thing. So that is still positive territory. If we subtract 1 standard deviation from this, we'll have what, 12% roughly, a little less than 12%. So that's the low end of that window. And if we add 1 standard deviation, 11.93 to this 23.65, that's going to be 33, 34% on the upper end. So we're ranging from 11% to about 34% on the upper end, and that's our confidence interval. That's a lot better than the individual stocks, where it could be pretty darn negative, like minus 14%, or pretty darn positive, like over 50%, over 60% actually, if we did the same confidence interval for these stocks. So that's pretty cool. What is going on there? Well, what's going on is there are actually two different ways we can think about risk. If we're measuring it with standard deviation, what we're measuring is the total standalone risk for each one of these assets. And it turns out that that's only really relevant to us if we're going to hold a single asset by itself. We can see that when we start combining these assets into a portfolio, the risk profile changes. So the more relevant measure of risk to us, because this is strictly a better choice. Any investor, unless they just happen to be risk loving and they want to take on more risk and they're willing to give up return to do it, which is not how most people tend to behave. Most of us dislike risk. And so if we have a chance to eliminate risk and maintain return, we'll take it. This portfolio of Initech and Fixitech stock is strictly superior to holding either one of them by themselves. We capture all the return and we get rid of some of the risk. So every investor who is risk averse would prefer to hold this portfolio instead of either one of the individual assets. Okay? So the relevant measure of risk turns out not to be the standard deviation, not the total standalone risk of each one of these stocks, but instead the risk that each one contributes to the portfolio of assets. That's the relevant measure of risk. So we've got to come up with a way to measure a particular asset's contribution, their risk contribution to a portfolio. And we have a concept to capture this. We call it the market portfolio. And this is from the capital asset pricing model, or CAPM. The market portfolio is a theoretical portfolio. It doesn't actually exist. It's just an idea. And in this theoretical portfolio, every available risky asset in the world is contained within it. Anything you could possibly invest in. So what happens is we have all of these risky assets in there. And so all of the risk that can be eliminated by combining things in a portfolio is eliminated. And that's what we call diversification. When we put two things together instead of holding one, and the movements in those assets tend to cancel each other out, that is diversification. And the risk reduction is our diversification benefits from doing that. Well, the market portfolio is as diversified as you can possibly be. You've eliminated all the risk you can eliminate. But it doesn't, even in that theoretical world, it doesn't get rid of all the risk. What remains is what we call market risk, or non-diversifiable risk. There are no more assets we can add to this thing to gain diversification benefits. So we call the risk that remains non-diversifiable risk, or market risk. So what we care about with one of these assets is not its total risk, but the risk that it would contribute to a well-diversified portfolio, and that is exactly what beta measures. Beta in practice is a regression. We'll just run a basic regression, and it'll form the slope of a line, and it'll tell us for a given asset, for every 1% change in a well-diversified or in the market portfolio, what percentage change can we expect in this particular asset, right? And that'll be an asset's beta. Every asset will have a beta, and it measures its exposure to this market risk. And there are a few examples on that where we actually chart it out and map out different betas, where we have one stock that we call HB for high beta. We've got a theoretical market portfolio here, the returns on it. Say in 2021, it's 5%. Our high beta stock, its return it was 10% in that same year. In 2020, our return on the market portfolio, again a theoretical portfolio, was 10%. The return on our high beta stock was 20%. You'll notice that each one of these returns is about twice as big as the market return. So when we run through just this basic slope equation, the one you learned back in 8th grade for the slope of a line, we actually map out beta by doing that. And it tells us, if we chart it out, some of y'all are probably like me and like to see pictures. If we map out the return on the market portfolio on the horizontal axis and the return on an individual stock, these theoretical stocks as well, on the vertical axis, and we look at high beta, for example, this guy's got a slope of 2, and so if we look at the returns on the market, if we see a 5% return on the market, then we see a 10% return on this stock. Right? And likewise, it works in the opposite direction as well. If we see a minus 5% return on the market, then we'll see a minus 10% return on the stock. So the higher the beta of an individual stock, the riskier that stock is, the greater the variability we expect to see in that stock's returns relative to the well-diversified market portfolio, right? And that's the important point. Beta is measuring the risk relative to a well-diversified portfolio. I can probably sense some of y'all rolling your eyes there saying, well, that's all theoretical stuff. It doesn't, can't really apply that in the real world. And there's some truth to that. However, this is a widely used model, and there are ways we can kind of proxy this in the real world. It turns out the S&P 500, which is a collection of 500 stocks in the US, represents almost 70% of the available risky assets that we're aware of. So it turns out to be a pretty darn good proxy for the market portfolio, at least historically. So what we'll do is we'll tend to just collect data on the S&P 500 or maybe a Wilshire 5000 index or something like that. We'll estimate or proxy the market portfolio somehow, and then just run a regression for an individual stock based on that market portfolio and estimate a beta for it. Right? And that's how that tends to be done. We can actually come up with of course, it's an estimate for an individual stock's beta, but we can come up with an estimate for it. Okay, what do we do with it? Well, the capital asset pricing model, what it really measures is what we call the required return for asset I. And asset I is just whatever asset, right? It's just a variable standing in for it. It says that the required return for an individual asset is equal to the base of a risk-free rate, right? The risk-free rate doesn't have risk associated with it. It's just compensation for the time value of money, inflation, that kind of thing, right? So we start with that base. And then what we add to that is a risk premium for asset I's exposure to market risk. Okay, the risk-free rate, we can collect that. We can observe risk-free rates. What about this risk premium for asset I's exposure to market risk? This is how we measure that guy. The risk premium for asset I's exposure to market risk is equal to beta that we just talked about times what we call the market risk premium. Oh my gosh, another term. What the heck is the market risk premium? Well, the market risk premium is defined as the expected return on the market, what we think the market portfolio is going to return over this window we're interested in measuring the assets return over. So the expected return on the market minus the risk-free rate. So sometimes this is called the market's excess return. Most often you'll see it referred to as the market risk premium. Okay, putting that all together, here's what that looks like. We've got the required return on asset I is R sub I, which is the variable we're going to use to stand for that, is equal to RF, or the risk-free rate, plus this last term here is the risk premium for asset I's exposure to market risk. We're going to take beta. Remember, that's the stock's sensitivity to market risk. What percentage change in the stock's return we can expect to see for a given change in the market's return. So we're going to take that beta and we're going to multiply it by the market risk premium. That is the expected return on the market minus the risk-free rate. Right, why are we subtracting the risk-free rate off of here? Well, that's going to be built into the expected return on the market. It's going to have that same base level built into there, and we've already accounted for it here. So we're going to subtract it off right here before we multiply it by beta. And there's some other sort of mathematical reasons how this is constructed and why it's built this way, but we don't want to double count the risk-free rate, essentially. All right. That gets us all the way to actually being able to calculate this thing. Now we know what some of this stuff is, and we'll unpack a little bit more about the required return as we go through it. Okay, so again, let's go through the problem. Suppose you're considering buying a stock with a beta of 1.7. What is your required return given by the CAPM if the expected return on the market is 9% and the risk-free rate is 2%? We're just going to plug in all the information that we've got. The risk-free rate is 2%, so we'll turn it into a decimal and plug it in as 0.02. Beta is 1.7, so we'll plug that guy in here for beta. And then our expected return on the market is 9%, expressed as a decimal is 0.09. And then again, we subtract out the risk-free rate. Now, order of operations is important here. This market risk premium is in parentheses, so we want to make sure and do that subtraction first before we multiply beta, right? And let's think about what's going on right here. So the expected return on the market is 9%. We subtract out the risk-free rate, so we expect the market return 7% over and above the risk-free rate. The stock has a beta of 1.7, which means we expect its returns to be magnified 1.7 times, or we expect them to be 70% higher than the market, or I should say 70% greater in magnitude than the market's returns, because that would also work in the opposite direction. If the market were down, say 5%, it was a minus 5%, or we expected it to be down 5%, then we would expect the stock to be down even 70% more than that. But when we multiply these two together, in this case, we're expecting the market to be up 7% over above the risk-free rate. We multiply 1.7 times 0.07. Then the expected return on our stock, or excess return on our stock, because this doesn't include the risk-free rate, is going to be 11.9%. So a beta of 1.7 for this stock means that if we expect the market to be up 7%, then we expect this stock to be up 11.9%, or 0.119 as a decimal. And excess return, that's over and above the risk-free rate. So when we add the risk-free rate to that, we get 13.9%. Okay, what does that mean? A lot of times the CAPM can be sort of bent to fit different purposes, but if we're being strict with the theory here, what we've plugged in is the expected return on the market, what we think is going to happen next period. And that's also the case with the risk-free rate, actually, which we'll have to proxy with the rates we can actually see in most cases. But these should all be expected returns. We've calculated its beta, which is exposure to market risk. This is the risk metric, beta 1.7 for this particular stock. So this return of 13.9%, what it actually measures is this is the minimum expected return that would compensate us to hold this stock, right? This is not what we expect the stock to do. This is what we need it to do in order to consider holding it as an investor. So what we would do with this rate is we would compare it to what we think the stock is going to do. We'd make some projections, say, hey, what do we think it's going to return next period? Is it greater or less than 13.9%? If our required return, as it is in this case, is 13.9%, we do some analysis and we think the stock is going to return something like 20%, then it is more than compensating us for the risk we are taking on by adding it to our portfolio, and we would want to buy it. If the expected return on the stock was, say, instead 5% next period, well, then it's not going to return enough to compensate us for the risk of adding it to our portfolio, because we need a minimum of 13.9% in order to justify taking on the risk that this stock would add to our portfolio. So that can often get mixed up depending on how we're using the CAPM. But if we want to be precise in how the theory is put together, this is the required return. It's the minimum return we need to see in order for us to hold the stock. Now, there's some issues with that. I don't know who's going to watch this video outside of the class. I can imagine getting attacked by some finance professionals or other academics. Of course, in real life, we can't observe expected returns. We're going to use historical proxies. So when we're doing that, we're actually estimating it. You can make an argument that what we're actually measuring is the expected return, but we're going to start with the theory, and then we'll talk about some limitations on it later in the chapter and how it actually gets used. But for now, I just want to be really careful about what beta is measuring and why it matters, why it's a better or a more relevant measure of risk than standard deviation is for a given asset, and also what the required return is actually giving us, what the output of the capital asset pricing model is for us.